Define the accounting cycle and demonstrate understanding of the 8 steps. The accounting cycle is the sequence of procedures used to record, classify, summarize, and report financial transactions for an accounting period. An accounting period is the time interval for which financial results are prepared, such as a month, quarter, or year. The purpose of the accounting cycle is to ensure that all transactions are properly recorded and that financial statements are accurate. The cycle is repeated each period so that users receive consistent and comparable financial information. Following the accounting cycle helps maintain order in the accounting system and ensures that no important step is missed. The first steps of the accounting cycle involve recording and organizing transactions. Step 1 is recording journal entries for each transaction using the double entry system. Step 2 is posting these entries to ledger accounts so that each account shows its balance. Step 3 is preparing a trial balance to verify that total debits equal total credits. These steps ensure that the basic records are complete and mathematically correct before financial statements are prepared. If the trial balance does not balance, errors must be corrected before moving to the next steps. The next steps adjust the records so that revenues and expenses are reported in the correct period. Step 4 is making adjusting entries for items such as accrued expenses, prepaid expenses, and depreciation. Step 5 is preparing an adjusted trial balance after adjustments are recorded. Step 6 is preparing financial statements, including the income statement, balance sheet, and statement of cash flows. These steps ensure that the financial statements reflect all transactions and adjustments for the period and follow the accrual basis of accounting. The final steps complete the accounting cycle and prepare the system for the next period. Step 7 is closing temporary accounts such as revenues and expenses to retained earnings so that the next period starts with zero balances in these accounts. Step 8 is preparing a post-closing trial balance to confirm that only permanent accounts remain open. These final procedures ensure that the accounting records are ready for the next accounting period and that financial information is properly summarized and reported. Following all 8 steps provides a complete and reliable accounting process. Define a general ledger and explain its purpose. A general ledger is the complete collection of all accounts used by a business to record financial transactions. Each account in the ledger represents a specific asset, liability, equity item, revenue, or expense. After transactions are recorded in the journal, they are posted to the general ledger so that each account shows its cumulative balance. The ledger organizes information by account rather than by date, making it easier to see how individual accounts change over time. Because all financial statement amounts come from ledger balances, the general ledger is the central record-keeping system in accounting. The purpose of the general ledger is to provide a structured and detailed record of all financial activity of the business. By maintaining separate accounts for each type of transaction, the ledger allows accountants to track balances accurately and prepare financial reports efficiently. For example, the cash account shows all increases and decreases in cash, while accounts payable shows amounts owed to creditors. This organization makes it possible to monitor financial position, control operations, and detect errors. Without the general ledger, it would be difficult to summarize transactions and prepare reliable financial statements. The general ledger also supports the double-entry bookkeeping system. Each transaction posted to the ledger includes both a debit and a credit, ensuring that the accounting equation remains balanced. Because all accounts are maintained in one place, the ledger allows accountants to verify that total debits equal total credits. This helps identify mistakes in recording or posting transactions. The ledger therefore acts as both a record-keeping tool and a control mechanism that helps ensure the accuracy and completeness of accounting information used for reporting and decision-making. In addition, the general ledger is used to prepare the trial balance and financial statements at the end of an accounting period. Account balances from the ledger are listed in the trial balance to check for equality of debits and credits. After adjustments are made, the final ledger balances are used to prepare the income statement, balance sheet, and statement of cash flows. Because the ledger contains the official record of all accounts, it provides the foundation for the entire accounting cycle and ensures that financial reports reflect the true results of business activities.